In the realm of life insurance, the calculation of premiums is a meticulous process that hinges on three fundamental factors: mortality, interest, and expenses. These elements collectively determine the amount insurers charge for providing coverage per $1,000 of insurance. Here's a detailed exploration of each factor. Mortality refers to the statistical likelihood of the insured individual dying within a specified period. Insurers assess mortality risk based on actuarial tables that analyze mortality rates across different demographics, ages, and health conditions. Factors such as age, gender, medical history, occupation, and lifestyle habits, like smoking, influence mortality risk assessment. Younger individuals generally have lower mortality rates, resulting in lower premiums, while older individuals or those with higher risk profiles may face higher premiums due to increased mortality risk. Insurers use mortality tables and actuarial science to estimate the probability of death and set premiums accordingly, ensuring that they can cover anticipated claims while remaining financially stable. Interest plays a critical role in premium calculation by reflecting the investment income insurers expect to earn from the premiums they collect. Insurers invest premiums in various financial instruments such as bonds and equities to generate returns over time. The interest component of premium calculation considers the anticipated investment earnings and the time value of money. Insurers factor in prevailing interest rates, economic conditions, and investment strategies when determining the portion of premiums allocated to cover future claims and administrative costs. Higher expected investment returns may result in lower premiums, while lower returns may necessitate higher premiums to ensure sufficient funds for claims payments and operating expenses. Expenses encompass the operational costs incurred by insurers to administer policies, process claims, manage investments, and maintain regulatory compliance. These expenses include underwriting costs, sales commissions, administrative overhead, and other business expenses. Insurers incorporate these expenses into premium calculations to cover the costs associated with issuing policies and providing ongoing service to policyholders. Efficient management of expenses is crucial for insurers to maintain profitability and competitive pricing in the life insurance market. Insurers strive to balance premium affordability for policyholders with the need to cover operational costs and ensure sustainable business operations over the policy's duration. The mortality factor, also known as the mortality multiplier, is a numerical value used to adjust base rates to reflect the mortality risk associated with different demographic groups or individuals. It serves as a multiplier applied to the base premium rate to account for the likelihood of death within a specific age group or risk category. Insurers use mortality factors derived from actuarial tables and statistical models that analyze historical data on death rates across populations. Factors such as age, gender, health status, occupation, and lifestyle habits influence mortality factors, with higher-risk individuals typically assigned higher factors, resulting in higher premiums to compensate for increased mortality risk. The mortality rate refers to the frequency of deaths within a specific population or group over a defined period, typically expressed as the number of deaths per 1,000 individuals per year. It is a fundamental measure used in actuarial calculations to estimate the likelihood of death among insured individuals based on demographic factors and health characteristics. Mortality rates vary significantly by age, gender, geographical region, and socioeconomic factors, influencing life insurance premiums accordingly. Insurers rely on mortality rates from mortality tables and actuarial studies to predict future mortality trends and set appropriate premium levels that reflect the expected cost of providing death benefits to policyholders. In contrast to mortality rates, morbidity rates measure the incidence or prevalence of illness, injury, or disease within a population or group over a specified period. Morbidity rates are crucial for assessing health insurance risks and determining premiums for policies that provide coverage for medical expenses and disability benefits. Factors influencing morbidity rates include age, gender, pre-existing medical conditions, lifestyle choices, and access to healthcare services. Insurers use morbidity data and actuarial analysis to estimate the likelihood of policyholders filing claims for medical treatments or disability benefits, adjusting premiums to account for anticipated healthcare costs and risk of disability. In conclusion, the factors influencing premium calculation in life insurance, mortality, interest, and expenses, are intricately interconnected and essential for insurers to assess risk, manage investments, and maintain financial stability. By understanding these factors, insurers can determine appropriate premiums that reflect the level of coverage provided while meeting their financial obligations to policyholders. Policyholders benefit from transparent pricing based on actuarial principles and market conditions, ensuring that life insurance remains a reliable and affordable financial planning tool for protecting against unforeseen risks. Click on the link in the description below for your free ebook titled Understanding Your Options. And don't forget to subscribe to our channel for more helpful insurance info and tips.